How will the Fed react to a new Trump administration? We'll talk about the importance of planning for healthcare expenses in retirement, and should you check with a financial advisor before making a big ticket purchase. All this and more. Let's go ahead and actually dive into it, because Donald Trump is returning to the White House. What is the stock market going to make of that? Here's investment strategist Stephanie Link on CNBC.
We already have a decent economic environment. We're running at about 2.5% in GDP. The consumer continues to spend. You have a lot of cash on the sidelines, $6.4 trillion in money markets. So I think you're going to see a nice rally into the end of the year. Remember, under Trump, his first term, from the eve of the election to mid-March of 2017, the S&P 500 rallied 11%.
Now that the election is over, what are you telling clients that may have potentially been sitting on cash?
Yeah, look, I mean, it's we've already been making moves. We've made moves already. I mean, there's people that we talk to that we're not managing their money. We're not doing any advisory work for them, but it's time for them to get off the pot and get rolling with this and take advantage of the opportunities depending on, what their situation is. But now this is a great outcome for all Americans, even American business, where they can look at how they can expand and grow their business and grow the valuation of their company, grow their stock price. And, we have to take advantage of the opportunities when they come along. So this is something that we have to, we got to make sure people are allocated in the correct areas for the goal and follow the plan that is put in place.
Again, sticking to the plan, John and the team at Matthew James Tax and Wealth Management, they've always accounted for the fact that, the markets will fluctuate regardless of who is in the White House, who is in charge in D.C., but knowing that there are times to pivot, being financially nimble. Now they are presented with a great opportunity right now, so it is a good time to see if there are positions that can be made. Let's actually talk about the tax implications here, because, again, Matthew James Tax and Wealth Management, John, Trump says that he wants the tax cuts that he passed in 2017, he wants to make them permanent. So should those that were contemplating a Roth conversion continue to stay the course, or should they maybe take a pause and wait a while on that?
Well, look, I mean, let's just stay the course on doing Roth conversions, but then, we can also do Roth conversions without even paying taxes. So for people that are, qualified, people that are accredited investors that have a investable net worth of $1 million or more, we can utilize strategies to convert money from their IRA to their Roth without them paying taxes. And next year it's going to get even more lucrative, where we can convert $2 and $3 and $4 and $5 and more $1 million that's in an IRA to a Roth without paying taxes. Now, there's a secret sauce behind it. That those individuals that are interested, they're going to have to call the office to get that. I'm not going to give that much information without basically going through an assessment and signing an NDA. But I mean, we utilize some strategies that can help people move their money out of the tax code, get that money to become tax-free. And we even use Roth alternatives that are very lucrative as well, where we can make it a generational wealth tool with proper estate planning to get their money out of the high liability tax code itself. I mean, even though we're going to see we should be seeing the estate tax thresholds for the death tax lower tremendously. We still want to take advantage of it because of the amount of debt our country has. So, even though things are looking bright, future's looking bright, things are getting a lot better, we still need a plan because, we're only one administration away from things changing. So obviously, he's going to be coming in. We got the next 4 years and we're going to see what's going to happen after that. But we got to play the long game. We got to play, there's people that were retiring when Reagan became president, and look how much has changed since then. So, even though that Trump is going into office, we got to play defensive on who's going to be following him. If it's a positive, person that's going to be in charge, that's one thing. But whenever it changes direction, and that's what we have to be more fearful of, and we have to make sure that we're taking advantage of the opportunity. But now, while taxes are going to be extremely low and tax strategy is going to be increasing because of the things that are going to change with the future tax code starting in the beginning of the year, we want to take advantage of these opportunities to lower someone's income, to create an offset so we can turn around and convert money from an IRA to a Roth. Now keep in mind, the way we're doing this is we have to, if you have money in a 401k, you have to roll it to a traditional IRA, because if you're trying to do a Roth conversion directly from a 401k, there's a mandatory withholding of 20%. Well, what if we're doing something where you're not even have to pay taxes at all? Why have a withholding to get your own money back and a refund, and you can't reapply that money back into the Roth or anywhere else? So ideally, we have to take certain steps in place. But the key thing, this is a strategy that we're using for accredited investors, where we can help them move 6 figures or 7 figures, even 8 figures a year from their IRA to their Roth without even paying taxes. Now, I know for a lot of people, they're hearing this and thinking, sounds too good to be true. There's something, being skeptical about it. I'm not giving the full detail, on the radio show, but this is something that we use to offset people's income as well, that are business owners or physicians or highly compensated, let's say executives or salespeople. We utilize this particular strategy that most people in the accounting world only think it's used for business owners, but we can use this for retirees and W-2 earners as well. But most people are not aware of it. So it's something neat that we have in our back pocket that we get to utilize as a strategy to help build more tax-free wealth.
It's definitely something we're taking a look at, and just because the term tax cuts are potentially going to be extended, it doesn't mean you should wait to take advantage of these tax rates. Quite the contrary, it means you've got more time on your side to take advantage of them. This is not a new tale. This is something that John has been talking about since 2017, when these tax cuts were first put into play, making sure you get to take advantage of them, keep as much of your hard-earned money as possible. Maybe that does include looking at conversions or finding ways to offset that tax liability that will certainly come down the line at some point. 36 trillion, potentially 36 trillion, and rising in national debt right now. The money is going to have to come from somewhere down the line. So being proactive about it, putting a plan in place, and again, the story hasn't changed. There's no time like the present to really begin doing that. You just have more time on your side potentially to take advantage of these tax rates as they are right now. John and the team can help map out a strategy for you and make sure you get to keep as much of your hard-earned money as possible. To find out more, all you have to do is schedule a time to speak with them. Go to MatthewJames.com or give a call, 366-8366. Once again, that phone number, 366-8366. Set up that time to speak with John and the team at Matthew James Tax and Wealth Management. This is the Retirement Roux here in KPEL 96.5. We appreciate you joining us this week. Going to take a quick break. Conversation continues right after this.
Visiting with John Blanchard with Matthew James Tax and Wealth Management. John, let's talk taxes. How concerned do we need to be with potential tax hikes in the near future?
Well, that's something that we need to be really concerned about, because when you look at the amount of spending that our government has had, you look at since 2006, 2008 time period to where we're at now, it's a substantial amount of debt that's on the books. And we're not just talking about that debt. We have to look at the unfunded liabilities of Medicare, Medicaid, and Social Security. So, this could be anywhere from about $160 to a $200 trillion debt load that's on this country, not just the almost $35 trillion of debt that we have right now. Because at the end of the decade, they're expecting our national debt to get to $40 trillion. And that's a substantial amount of money. And we have to look at, how are we receiving income? What kind of taxes are we paying? We know that we're scheduled for a tax increase January 1st of 2026. But November is going to be a determining factor. Will our tax code stay the same a little bit longer, or is it going to jump up even more? Because in 2006, David Walker, he was the former Comptroller General for the country, he stated that our tax rates must double or our government's going to go broke. But we were at $6 trillion of debt at that point. Now we're at 34, approaching 35. So that's a big issue. And so we have to look at this and position our assets to where they're in tax-free accounts so we can take that burden of the IRS on our accounts. Getting rid of that tax lien is something big that we need to look at, and we need to plan and position ourselves over these next couple of years and even over the next decade.